Chief Investment Officer of Beacon Wealth Consultants, and this is your January 2021 market update. Well, after a nice run during the first 3 weeks of the year, the stock market lost some ground last week as it became apparent that a few new variants of COVID-19 are starting to circulate in the United States, while vaccine distribution remains slow in many areas of the country. And much of the move lower came just last week after an army of retail investors used social media to gang up on some hedge funds, causing them some painful losses. And this has led to concerns about market stability and a potential market manipulation, causing some investors to take profits following a very strong fourth quarter. For the month of January, domestic large cap stocks were down 1.01%. Small cap stocks, which is where some of the trading frenzy and inflated prices in a few of those stocks occurred, was up 5.03%. International developed market stocks was down marginally, losing 1.07%. Emerging markets and commodities both had small absolute returns. And on the bond side of the equation, interest rates increased a bit, which led to some losses in both domestic investment grade bonds, the Barclays Aggregate Bond Index shown there, as well as the emerging market bond index. I've received quite a few questions surrounding the market activity in stocks such as GameStop and AMC over the last week. And so I want to take some time to explain what's going on and why this has led to some market volatility as of late. Let's start by giving you a quick run through of what short selling is and why firms, especially hedge funds, do it in the first place. Short selling is a common but controversial way of trading in the financial markets, and investors engage in short selling as another way to gain profits. In order to sell a stock short, a trader, commonly from an institution such as a hedge fund, borrows a stock that they do not own. So in this example, the trader borrows 100 shares of a stock from a broker and then sells them at the current market price of, say, $50 per share, collecting $5,000. Now, a trader would want to do this if he or she believes that the company's fundamentals don't support its market value, which was the case for GameStop and some of the other stocks that were in a bit of a trading frenzy last week. The trader believes that the security's price is pointed downward, and if a decline were to take place by shorting a stock, a trader can make profits. So how do they actually take advantage of a negative trend? Well, once the price drops to, say, $25 a share, they buy their 100 shares of stock back at the current market price of $25, so a cost of $2,500. And then the trader returns 100 shares of the stock to the broker and earns a profit of $2,500. So in summary, short selling allows investors to make money even when a stock is going down in price. And some even contend that shorting is good for the market because it helps bring overvalued stocks back to their fair values and warns others of risky stocks. However, when you short a stock, it's a very risky endeavor, and you really need to know what you're doing. When you buy a stock, the most you can lose is what you paid for it, because a stock can only go down to a $0 market value. However, when you short a stock, the maximum loss is unlimited because the stock could keep going up in value. So let's just walk through a quick example of that. Same trader borrows 100 shares of stock from a broker, sells 100 shares at $50 per share, collecting $5,000. But instead of the stock going down in price, the stock increases in price to $100 per share. The trader, in order to cover how much he's borrowed from the broker, the trader is forced to buy back the shares at a higher price. So the trader buys 100 shares of that stock at $100 per share, so a cost of $10,000. And then the trader returns 100 shares of stock to the broker and loses $5,000 on the trade. So basically, what to know here is that the higher a stock's price goes, the bigger the loss the short seller sustains. And then when that happens, short sellers are in a bind. They need to return the shares they borrowed back to the lender, but now they find themselves buying back at a higher price, not a lower one, and the bet is backfired. In the markets, this is called a short squeeze. And this is what happened to GameStop, a struggling video game retailer, and some other stocks last week, as members of a Reddit forum devoted to stock trading collectively sent shares of several companies through the roof, as you can see by the parabolic move on this chart. GameStop gained over 1,600% in January alone, as Reddit users egged each other on to buy in an effort to blow up hedge funds. A few hedge funds were caught up in this and lost billions of dollars. Then the stock plummeted as online brokerages took the extreme step of cracking down on trading to stem volatility. That prompted an outcry, a lawsuit, and calls for congressional hearings, only to see the stock rise back again as trading was restored at brokerage firms. So it's been a wild ride for people who are investing in this particular stock. And at around $325 today, the share price is more than 10 times higher than it would be based on the company's fundamentals. So it's fair to say that the market is completely disconnected from GameStop fundamentals here and in a handful of other stocks that are showing the same type of trading due to some online Wall Street forums. And this really is a glimpse of what's known as the greater fool theory playing out. The greater fool theory states that investors can achieve positive returns by buying an asset without concern for its true value because someone else will buy it at a higher price. So investors expect to make more profit because another investor, or the greater fool, will be willing to pay even more. And so while a few people may be able to get rich quick on this particular scheme that's going on right now, it's likely to end very badly for most investors. Rather, I probably should say speculators there, as the trade unwinds, which eventually it will. Proverbs 21:5 warns against this type of activity. Steady plotting brings prosperity, but hasty speculation brings poverty. And we do not engage in this type of activity at Beacon Wealth. However, what's the bigger picture here? What does speculation in a few areas of the market mean for my portfolio at Beacon? Well, we are researching the potential spillover effect and will make changes as warranted. The concern, which led to some losses late last week for the market, is that if this type of activity gets broader in scope, it could lead to forced selling by hedge funds, pension funds, or banks, which would increase overall market volatility and lead to some instability of the financial system. All that being said, though, the Securities and Exchange Commission is looking into this very closely. That's the regulatory body that oversees the stock market. The SEC issued a statement warning traders about engaging in illegal schemes to drive up share prices and said it is working with regulators to identify and pursue potential wrongdoing. Additionally, there's likely to be a congressional hearing on the matter, as it has caught the attention of lawmakers on both sides of the political spectrum. The good news, at least for now, is that the frenzy remains very much contained in a narrow subset of equities. And if you are an investor with us, it's important to remember that we are not index investors, meaning that we don't buy up a basket of stocks just because the companies are a certain size or they're in a certain market component that we want to access. Our LightPoint portfolios do not have exposure to these companies that have been targeted as of late. We do watch market levels very closely, and we did rebalance the portfolios in January to take some profits because we expected there to be at least a pause that refreshes or a bit of a pullback to occur over the next few weeks, which seems to have started last week. And what I want to just remind you of is that as we work through this recent bout of market volatility, it's important to remember that pullbacks are a normal part of investing. You can gain important perspective on market pullbacks by considering post-World War II declines in the S&P 500 index. So the majority of declines, 84 to be exact, fall within the 5 to 10% range, with the average length of a pullback lasting 1 month and the average recovery time taking about 1 month. So while a pullback can be emotionally unnerving, especially given the recency effect of the 2020 market sell-off, a pullback will generally not undermine a well-diversified portfolio. And we study the markets daily, and we will make changes to the portfolios as warranted by our outlook. As always, we thank you for your continued confidence, and please reach out to us with any questions you may have.